You buy Bitcoin, you hold it for more than 4 years, Joe. That's my advice to everybody.
Fair to say you simply flooded the system with money?
Yes, we did. That's another way to think about it.
Where does it come from? Do you just print it?
We print it digitally.
I'm very bullish on the long-term viability of Bitcoin.
I was going to say, did that surprise you?
That surprised me how much that's gone up.
Hey Internet, welcome back to another episode of New Foundations, the podcast brought to you by Acropolis, the Bitcoin Treasury company. I'm Mason Carter, back again this week with my co-host, CEO of Acropolis, Chase Palmieri, and this week, very excited to have Chris Kuiper in the studio. Chris is the VP of Research at Fidelity Digital Assets. He's a chartered financial analyst, has a background in research, and many people who listen to this podcast probably follow him on X. He's got lots of great insights and research in regards to Bitcoin and the general macro environment. So welcome to the podcast, Chris.
Thank you. Glad to be here.
Really excited to, cover some general Bitcoin Treasury adoption trends, get your thoughts on where we're going in 2025 and beyond. I know your team at Fidelity Digital Assets has been tracking, the growing trend of companies adding Bitcoin to their balance sheet, which is obviously what we specialize in. So what do you see as the primary motivation driving this in 2025? And do you expect this to play out quickly over the next 12 to 18 months? But what is your general timeline along with that?
It's an excellent question. And we released our 2025 look ahead at the beginning of January. And I opened the report with this idea that at least I think, we may be turning into this new chapter, this new era of Bitcoin, where it's the start of where Bitcoin becomes integrated into all areas of the economy. And one of the things I referenced was this book we read as a research team. We do kind of a book club, reading together and talk about what we read. And a few years ago, we read this book by economist Carlotta Perez, Technological Revolutions and Financial Capital, or something like that. It's got a long academic name. And she wrote this many years ago, before Bitcoin was even invented. But she goes through really big technological innovations. And of course, you don't always know these until after the fact, but think of the big ones like the steam engine, railroads, microprocessors, the oil industry. And she notes how something reaches the point of major technological revolution when it not only changes its own industry, but it changes the entire economic landscape. So it embeds itself into other industries. It changes the way things are done, the way people communicate, the entire supply chain of things. And so it's a pretty bold thing. And not to put words in her mouth, because she's actually said on X or Twitter, I believe, that she doesn't think her theory applies to Bitcoin. But of course, when we read this, we couldn't help but apply this. And the other part of the thesis is the financial capital part, where she talks about how the booms and busts go along with the technological revolution, and it's actually they go in tandem. So it's like they need each other, right? You have to have the financial capital to progress the technological revolution. So I think we've seen booms and busts that have helped bring this technology along. And now we may finally be getting to this stage where the technology is at the point where it's going to be a lot more sustainable, and it's going to start embedding itself in all these other industries. So to get back to your question of corporations, it's not just about Bitcoin, the technology, it's about Bitcoin, the capital asset, right? And anchoring their balance sheet with a capital asset that they know can't be diluted, something they can hold directly if they want. Things that you've talked about on this podcast many times, pristine collateral, something that they can build their other things against. And if you have all those characteristics, as you've mentioned before, you can have a very cheap cost of capital as well, potentially. So that's what we've seen with corporations. It's different for them, but yet it's not. Corporations face the same problem that you and I face as individuals in an inflationary environment. And so they're looking at the same thing, but they face even more pressure, right? Because they either have shareholders or owners to answer to, and they have to make a return on that capital. And of course, if they're running uphill or running on this treadmill of a debasing unit of account and currency, it makes it that much harder for them. And so that's what we're seeing with corporations that are taking the very proactive step, and they say this in their announcements and their shareholder letters. Like, this is why they have this very Bitcoin mindset when they announce it. But I think other corporations, to answer the second part of your question of how long this will take, I think other corporations will start to do it just out of copying or necessity or kind of the defensive game theory part of it. But then, of course, the risk is they won't stick to it because they're not understanding at a core fundamental level. So I think you'll see both. And then to get back to my other point too, the Carlotta Perez thing, these things take not just years, but decades to play out. So I think ultimately this is a trend of 10, 20, 30 years playing out. But of course, you may see some like spurts of growth as some of them quickly adopt Bitcoin on their balance sheet.
So we have a mix of people that listen to the podcast. Obviously, a lot of them are folks like ourselves who are all the way down the rabbit hole, but we also have some business owners that are kind of new to learning about Bitcoin, the asset class. And to Mason's kind of question there about the rising adoption of corporate treasuries or a Bitcoin on the balance sheet, if you will, there's obviously an opportunity cost. So how would you speak to kind of a business owner that's listening to this that is new to the asset class that maybe today relies on traditional treasury assets like cash or bonds?
Yeah, the thing about cash or bonds is it's something they've always done. They know it. There's all the infrastructure for it. So of course there's some trepidation about moving into this completely new thing that looks like, is it a currency? Is it an alternative? Is it a commodity? But I think just simply just say like, look, this is, if you want to think of it as an alternative currency, think of it as like a non-sovereign currency. Think of an international company. One of them might have back in the day held Swiss francs, right? Remember that the Swiss franc was like deemed the hardest currency available. And people would move a portion of their cash or treasury into Swiss francs as stability, especially if they operated in countries with very volatile currencies or highly inflationary currencies. So if you take something like that model or mindset, it's not that different, right? You're moving a portion to something that is the hardest currency on earth and something that's not only hard, but you know that it will continue to be hard. You know exactly how many Bitcoin will be created. And so you can think of it as a pretty, not a wild, crazy move, but as potentially a pretty prudent move because you can, and again, the company can choose how much they want to do, but you're just moving some portion of your cash that you know you won't need for at least the next few years into this hardest currency and asset that we've ever seen. And that gives you optionality, right? It gives you a hedge. It gives you, again, access to this potentially pristine collateral. So that's the way, one angle that you could come at to these companies to try to get them to see like, this isn't as crazy as you think or what you may have heard, and here's why.
Embrace the future of corporate finance with Acropolis, your strategic partner for a Bitcoin treasury strategy. We're the experts your business needs. Acropolis offers trusted Bitcoin advisory. We provide you with an outsourced Bitcoin strategy officer, world-class research, and a creative financing team, and more, so you can navigate Bitcoin's market with confidence and acumen. Best-in-class custody with multi-institution custody. Eliminate the risk of loss while maintaining full control of real Bitcoin. Acropolis exclusively uses multi-institution custody as the safest and easiest way for businesses to hold Bitcoin. Bitcoin-only solutions. The Acropolis platform is designed for businesses of all sizes to seamlessly manage their Bitcoin treasury, and we focus solely on Bitcoin to offer you the most specialized services available. Adding Bitcoin to your balance sheet is just the beginning. With Acropolis, you're not just adopting Bitcoin, you're mastering its strategic use to create and maintain value for generations. Take the first step and start your corporate Bitcoin journey with Acropolis. Book your free consultation today at acropolistreasury.com/book and start implementing our proven strategies within days. How do you think the macro environment, say inflation, interest rate trends, is influencing corporate treasurers in their consideration of Bitcoin as a strategic asset? Because I think there's been a lot of confusion on that front. People, and by people I mean treasurers, they were anticipating more rate cuts. They were anticipating perhaps inflation being transitory. So how is this influencing the broader decisions?
Yeah, our research shows that the two biggest drivers of Bitcoin price on the macro front, if you're looking at like factors, are global liquidity and inflation expectations. And in our look ahead piece, which we drafted back in Thanksgiving time to get it out at the beginning of the year, one of the things I posed was, why isn't anyone talking about stagflation? And not to say this is a prediction, and it's not necessarily even my base case, but good investors always consider all the probabilities, all the possible scenarios, and see how those probabilities shift. And at the time, and still currently, inflation is being very stubborn. It's not getting anywhere near that 2% that the Fed had laid out as a goal. And notice too how the goal is now 2%, not 0 to 1,
right.
0 to 2, but it's flat 2%
It's now 50% higher than
exactly.
the baseline.
So let's just acknowledge how the goalposts creep here. But even just trying to get it back to 2% is proving very difficult. It's being sticky. And that just, to me, brought up this question of, well, what if we don't get back to that? And what if we actually reaccelerate from here for whatever reason, whether that be the high structural fiscal deficits we're seeing? Investors need to be prepared for that scenario. And the one corollary we have, which we reference in the report, is the 70s and early 80s, right? Everyone thinks, the high inflation of the 70s, like it was just one big homogenous high inflation of the teens. But if you look at it, year-over-year changes, it was 3 distinct waves, each one getting bigger in amplitude and coming back down. And if you overlay that with today, and again, this is not a prediction, I don't like really doing this with charts, like not trying to commit any chart crimes, but we're following the same pattern in that inflation peaked at a 40-year high of 9% in the US. We've come down, but now the latest prints are showing it's getting hot again. And so as a business or a company, you have to be prepared. You don't want it to happen, but you have to be prepared that inflation could reaccelerate from here for whatever reasons we could debate about it. And so I think that's one of the things that companies need to think about. The other is just the fact that if you take a longer term view, mathematically, there's not a lot of way out, at least in my opinion, for these structural deficits other than quite a bit of inflation. And that is actually a stated policy goal if you look at some of these papers from the IMF and others. And so as a business, you have to see what they're saying and what they're doing and realize this is likely going to be one of the paths that is pursued. And again, you need to be prepared for that. So every investor, just like every individual, is facing this same situation. It's not great. It's not like we want it to happen, but the reality of it is that it likely will, at least in my opinion.
So one of the things that we definitely wanted to make sure we asked you, because you all are putting out some of the best research in the space, and let me maybe paint a little bit of a background here. So Michael Saylor, running MicroStrategy, was able to move quickly with Bitcoin Treasury because he was still founder-led, majority shareholder, and perhaps most importantly, their company was stagnant and kind of in this zombie zone that Eric Semler of Semler Scientific is kind of popularizing that term right now for these types of businesses. So we're curious what type of companies you are seeing from your research seem to be most inclined to adopting a Bitcoin Treasury, and perhaps if there are any surprises in which industries are jumping out.
Oh, that's a good question. There certainly are those companies that you mentioned, like the zombie companies, where it's like this is a potential way out for them. But I think it goes beyond that. Like that paints a bleak picture of like it's the only type of play there is. Where I think the bigger play is companies that are actually very healthy and they have a lot of cash flow, but they just, as a prudent financial manager of a company, you of course have a bunch of different options to do with your cash. Give it back to the shareholders, reinvest it in the company. Buy back stock is also another way to give it to the shareholders, or a dividend, or pay down debt, right? And so a lot of companies you see invest in the company itself, or a lot of times go out and make big mergers and acquisitions. I used to be an equity analyst, and usually these mergers do not work out. There's always a lot of great numbers painted when they announce the merger. This is what we think it's going to do. This is what we think it's going to do to our revenue, our earnings, and how it will be accretive. And for many reasons, it usually does not work out. And there's a lot of academic research on this. But they're under pressure to do something with that cash, right? You've got a board to answer to. You've got to do something with it, or you got to return it. And of course, returning it might be the best decision. But of course, there's some incentives there to not return it, because then you're admitting like you can't find good growth opportunities. Whereas investing some of it in Bitcoin offers this other way of like, hey, we're going to sit on this, but this is not just idle cash that's going to slowly melt away. It's going to preserve its purchasing power, or perhaps even grow in its purchasing power. And that gives us the patience and the optionality to wait for when we see an opportunity to expand our business, go into a new market, maybe make an acquisition that makes sense. But it just relieves a lot of that pressure and a lot of those bad incentives, at least in my opinion. So I think that's another area that we haven't seen quite as many companies, because quite frankly, it's like the ones that have done it are on the periphery. They're a bit on the edge, and that was one of their options that they've gone for. But I think you'll see more companies realize, hey, this isn't just for companies in the zombie zone. This is for healthy, good companies as well, to preserve their cash and take some of those fiscal pressures off of them.
In preparation for this podcast, we consulted with our friend Tim Kotzman. Tim Kotzman is always wearing the orange tie. He's a huge Bitcoin and general Bitcoin equity bull. And he wanted us to ask you, how much inbound are you seeing from retail versus corporates versus institutions? How is that breakdown looking like right now?
Right now, I think we're at a very interesting time in that retail sentiment is very, very negative. And we're recording this on the 25th here. We've got this little crash going on here down to, I don't know, we're at 88,000 in Bitcoin or something, maybe lower now. So the four most dangerous words in finance, as they say, is this time is different, right? But I'll say this time is different, at least for me. I've never experienced quite this bifurcation between all the interest we're seeing and hearing on the institutional side versus what we're seeing in the price action and feeling and seeing on the retail side. It is just so bearish and nasty on the retail side. And I think a lot of that has to do with the other stuff going on, the meltdown of the meme coins and all of this other stuff. Whereas on the institutional side, I don't think you could stack up more positive developments that we've seen over the last month here, whether it's on the regulatory front, or whether it's these new companies announcing Bitcoin strategies, or whether it's new products being offered, or more financial institutions and banks saying they're going to custody it or build lending services on top of Bitcoin, whatever it is, or bigger players announcing big announcements into the space, whether trading or custody. There's so much interest on the institutional side. And again, that gets back to that original point of the Carlotta Perez of entering this new era of mass adoption, where the big players, the big infrastructure is moving in. We have it all in place, and now it's all happening on the institutional side. And these people are long game players, institutional players, right? They're the big money, they're the battleships that can't turn on a dime. And so they're looking past a lot of this noise right now. And we're seeing that anecdotally in our inbounds and questions and things we're getting from our clients. And we mostly work with, full disclosure, we mostly work with institutional clients on the Fidelity Digital Assets side.
Well, yeah, speaking to big players, and this time is different, this may very well be the year that we see the start of nation-state adoption, which is kind of kicking off the highest level game theory that most Bitcoiners who have followed this protocol to its logical conclusion kind of saw coming years ago. But, here we are. It could very well start with the announcement of an SBR from the United States this year. The working group has, I think, another 5 months or so to determine or conclude how they want to approach that decision within the United States, hopefully in a bipartisan way. But in the recent 2025 look ahead, which is the research report from Fidelity that we keep mentioning here, so everybody should go check that out. The report highlighted that nation state and corporate adoption are key trends in 2025. And I'm curious which you think is maybe going to have a bigger impact on Bitcoin over not this year, because I would imagine that an SBR announcement would have the biggest near-term bump, but over the next decade, which do you think is the bigger trend to keep an eye out for?
Yeah, as an analyst, I guess I'd have to run the numbers, like which one is a bigger pool of money. And I don't know the answer to that off the top of my head. But I personally think it would be the corporations, right? Because they're going to be the ones that are more autonomous, who are doing it out of their interest in their business. And that's going to have more network effects, right? With working with other corporations. Central banks can be kind of their own island. And as much as some of them are or should be politically independent, things can shift and change with them, right? Whereas I think corporations would be the more sustainable one, the one that gets embedded a little bit more. So that's just my personal quick take on that. But again, maybe the numbers would tell a different story if you actually compared those side by side.
So maybe just a quick follow-up there then. It sounds like maybe you don't envision nation states literally printing money to buy Bitcoin, because if you did, it would be hard not to see the nation state capital pool being larger. But if you're saying, no, I don't, maybe nation states will adopt it over time, or maybe sell some of their existing Treasury assets to balance into Bitcoin, then corporate adoption could be a bigger pool of capital. But I guess you're not maybe a believer that we're just going to start printing away fiat to buy Bitcoin?
For the U.S., probably not. That would be, considering we already are the global reserve currency, that might be a counterintuitively very bad move. It's like you're undermining yourself, right, as a country. If other countries did it, I think if you look at monetary history, anytime where there is just an observable flat out creating money to buy something else, a harder asset, that is usually the very last move of the game, the very end stage, right? And it is a quick collapse to the end for them. And again, I am a big nerd that likes to study monetary theory and history. And so I think history shows that would be the last gasp for any central bank or nation that embarks on that path.
We're talking about the history of nations and money and fiat, but never in history have you had the ability to just flee with your capital. If your capital was gold or whatever form of capital it was, if it's in some sort of digital form, as it has the last 25, 30 years, you can't exactly just get up and leave if your jurisdiction isn't friendly to it, or if they're not making any decisions regarding a strategic reserve. So I think this time could indeed be different. But referring to another one of your reports, I believe it was the Q4 2024 signals report, you talked about a 170-day acceleration phase. How should listeners of this podcast, who they may be into Bitcoin, they may be into the weeds, or they may be just a business owner, how should they interpret where we are in the market cycle today, given we're in late February 2025?
Yeah, so that's one model or chart you're referring to. And actually, just yesterday, we released a whole report just on this. So the analyst who's done all this work, really good work, Zach Wainwright on our team, he just put a dedicated report to this. So you can read all about the model, how it's constructed. It's pretty simple, but of course there's power in simplicity. It just looks at two things, the percentage of addresses in profit, and then the historical volatility, where Bitcoin is at in terms of its vol. And so you can have you're either in a high volatility regime or low volatility regime, and you either have a lot of addresses and profits or a low number of addresses and profits. And so between those two, you've got 4 permutations, right? And those 4 permutations make up 4 cycles. And we've seen Bitcoin go through these 4 cycles historically. So what he proposes in that report is we've entered the acceleration phase, when there's a high number of addresses in profit, which he marks as 95% or above, and volatility is high. This is historically when you've had the largest blow-off tops, the last part of the bull market cycle. And we're about halfway through that today, at least in terms of what has happened historically. Now, of course, past is no indication of future, but if you use that, that's where you get that metric that you just said. You've got maybe 90 plus days more historically. But of course, the cycles have been lengthening out a little bit. Now, that's just one model. And of course, that seems weird today. Like, what are you talking about? Blow off top, we're crashing down to 88. But there's a lot of other models we have in that report as well, so people can check that out. So to answer your question on where we are in the cycle, and this is one we get a lot. Obviously, I don't have a crystal ball, but I do think you can look at a lot of these market and on-chain signals to put the odds in your favor. Like if you're someone who's DCAing into Bitcoin and you believe in the thesis, you don't care about this, right? But you may be someone who either has a large lump sum of money that you want to invest, or you know you're going to need a large lump sum of money in the next few years, and you want to know, can I put the odds in my favor of taking this out at a better time rather than the bottom? Or if you're investing, I don't want to invest right at the top. And another one that we look at with this is the MVRV, market value to realized value. That one historically has been very good as well. And we're about halfway through the historical cycle as well. And now, of course, if you looked at it, we're pulled back a little bit. So again, in my mind, clearly, I think we are still in the bull market. And even these 20, 30, 40% drawdowns within a bona fide bull market are normal and have happened before. But of course, any time could be different, but we'll see and continue to monitor and bring all those charts out for everyone to see.
Mason and I are always impressed with your ability to kind of disarm the skeptical argument when it comes to Bitcoin, whether it's the different aspects of FUD that we see all over the place when it comes to Bitcoin being wasteful, it's not a store of value, it's backed by nothing, all these types of kind of FUD that we're used to hearing in the space. And so we created a little kind of segment here for you that we just called Address the Skeptics. And so these next three questions are kind of going to be us teeing up a typical concern or question, and then, us hoping to learn from your concise disarming of that point. So I'll go ahead and kick it off. So
like lightning round, concise kind of thing?
No, take your time. But like, the more concisely you can disarm this concern, obviously, the better for all of us who are learning your tricks in the trade. So I've got a lot of friends in my life who are broadly into crypto, but not into Bitcoin. They typically are developers and software engineers who see Bitcoin's proof of work protocol as unnecessary, wasteful, and inefficient. Obviously, we've heard you speak to it. We all understand that it's, the proof of work is what ties Bitcoin's value and scarcity to the real world. But how would you convince, these Solana or Ethereum maxis that it's not about the efficiency of the protocol, and that Bitcoin's proof of work is not wasteful just for the sake of being wasteful?
Great question. One analogy I say is if you ask me what's the best vehicle, I'd say, what do you mean what's the best vehicle? You got to tell me what you're going to use it for. For some person, the best vehicle is a four-wheel drive truck, which literally might save their life in their job or out in the wilderness. And another person, the best vehicle is a four-door fuel-efficient sedan that they drive to work every day. So that's the same question to me when they say it's Bitcoin's proof of work is wasteful. It's like, well, you're not looking at what the primary use of Bitcoin is. As a potential emerging form of money, aspiring store of value, you want the protocol to be anchored in the real world, and you want the governance to be limited by the physical properties of nature, things like conservation of energy and laws of thermodynamics and all that stuff. You want that to be outsourced to the neutral physical world, not insourced to the community, developers, or the internal ecosystem of it. And I know there's a lot of debate, but that's the most succinct way I can say it. You got to understand the use. If it's to potentially secure trillions upon trillions of dollars of value of people's savings and life work and energy, it's not wasteful at all. That's a very high value and high calling for the proof of work to fulfill.
Right. So essentially, it's actually incredibly efficient at storing value because it's not so easy to issue more tokens and attack the protocol. Okay, so one more for you here, and then Mason will get the last kind of skeptical argument in. If Bitcoin trades 24/7, 365, and therefore often takes the first hit when cracks appear in the traditional finance system as people are seeking liquidity. Does that undermine its role as this separate, uncorrelated asset that's meant to increase in value as the current system fails?
I suppose you could say it does in that very short-term, narrow window. But that could change in the future. And people have to know a little bit how Wall Street works, and this is my traditional finance background. The old adage is, you don't, in times of crisis, when you need to raise cash, you don't sell what you want, you sell what you can. And so they're forced to sell Bitcoin, these different participants, in times of crisis, precisely because they can sell Bitcoin 24/7, 365, and because it is a homogeneous global asset that anyone will recognize and take money for. That's actually what also makes it very valuable. Now, in the future, we might have a financial system that recognizes Bitcoin more for its core values, and they figure out ways to lend against it or use it as collateral, so it doesn't have to be actually sold off. Or conversely, maybe the rest of the financial world catches up and goes to 24/7 trading, and they're actually selling stocks and bonds rather than Bitcoin. Those are two different scenarios I see there.
So this one is a favorite of mine because I've always found it the most difficult to talk about, because people in general hate volatility. And it's funny, just an anecdote from when I worked at eBay. I held a session on Bitcoin for the finance org, essentially a Bitcoin 101. And one of the first questions I got at the very end was something around volatility, and I didn't have time to really go deep into it, but I said, hey, listen, volatility is a feature and not a bug. And then he goes, of course you would say something like that. Of course a Bitcoin maxi would say it's a feature and not a bug. But what would your answer be to that? What would your answer be when people are overly concerned about the volatility, especially in regard to adding it to a corporate balance sheet?
Yes, so to build on your point there, I'll borrow one of my favorite lines from educator Parker Lewis, who says Bitcoin is volatile precisely because it's valuable. So its hard cap is what makes it so volatile, right? The supply can't adapt, and so all changes in demand are expressed through changes in price, so it makes it very, very volatile. And of course, it's very volatile too because people are trying to figure out if this thing is going to be a $100+ trillion asset or zero. But those are the same characteristics that make it valuable. So you can't rip out or get rid of Bitcoin's volatility without removing the core thing that makes it valuable in the first place. So in some ways, there's just no way around that, and that needs to be accepted. So same as it's a feature, not a bug. The other part of it, though, is volatility is risk in the financial sense, but is it really risk to an individual or corporation if they're holding it for a long time? And this is where I was thinking about this the other day, and then again today with this whole little crash going on. People use these terms like risk on, risk off, and they say Bitcoin is a risk asset. It's a risk on asset, and what they mean is it's a volatile asset. So they treat it like other volatile assets. But let's think about this from the traditional finance perspective. This is me as this putting on my CFA hat, right? All investments are derived. The value of them, or the estimated value of them, are derived from their future cash flows, right? You say, what's the future cash flow of this thing? Discount it back to today. And that's why these risky, quote, risky assets like tech stocks are very volatile, because all of the assumptions are made about these large future cash flows, especially if they're high growth, right? And so any change in perception or a new data point that changes what people think those cash flows are going to have a big change on its price today. So risk is ultimately the loss of capital. And in the finance terms, risk is how risky are those future cash flows? Are the magnitude or the timings of those cash flows going to change? Now, of course, with Bitcoin, there's no cash flow. So there's nothing to assume or have to anticipate or estimate in the future there. And in fact, you know exactly how many Bitcoin are here today, how many will be tomorrow, how many will be next year and 100 years from now. So at its core fundamental level, it is like the least risky thing when you think about having to make assumptions about it, right? But people keep putting it in the same bucket. And so investors in Wall Street, they look at Bitcoin like another ticker on their screen, another asset to trade. and they look at how it's trading and how it's traded before and all the quantitative metrics on it. And I've said this before, but the thing I always say is I can pound the table all day and say, Bitcoin is not a risk on tech stack. It's fundamentally different. But if traders are going to treat it that way and trade it that way, unfortunately, that's how it's going to behave. It's like if everyone took a fork and they treated it like a spoon, I don't know, that's how it would be for a long time until someone says, wait a minute, this is fundamentally not a spoon, it's a fork. I can use it in a different way. And so eventually I think people are going to come around to realize Bitcoin is fundamentally different, and it should be treated different, it should be traded differently, and it should be thought about differently in the portfolio. So I don't know when that will happen or if it will happen gradually or all at once, but that's my personal opinion. We will hit that inflection point. And then I guess to make a really succinct answer, it's like if volatility is such a big deal, then just address it through position sizing with whatever you're comfortable with. Like you don't not own a good company or stock just because it's volatile. You just own a smaller amount of it.
That's what we preach to businesses. That's what we preach to all of our clients is volatility is a matter of position sizing or concern over volatility. So we wouldn't recommend any business put 100% of everything they own into Bitcoin. We would never do that. But yes, as long as you're sized correctly, you're going to benefit from the monetization of this asset. And we believe it's a once in a species opportunity, once in a generation opportunity. So before we end here, I want to share my screen and pull up the Bitcoin chart, for those in the future, because not everyone's going to listen to this week, but just want to show this is the 7-day chart. We've absolutely crashed to 87,000. But as we've been describing this whole episode, let's zoom out to the 1 year, let's zoom out to the 5 year, and look at this asset. Fundamentally, this is just as normal as any of these, peaks and troughs all the way, from the last 16, 17 years that this network has been in existence. So just wanted to share that. But Chris, I think I have to say this is going to be one of my favorite episodes of New Foundations. I really hope that all of my friends and family and clients listen to this, because it's really just so jam-packed full of high signal information. So really appreciate you coming on. Before we end, if you could just tell the folks where to follow you and find all of this research that we've been referring to.
Yes, all of our research can be found at fidelitydigitalassets.com. Just click on the research tab there. And I am on X at Chris J. Kuiper.
Awesome. Thanks for coming on, Chris.
My pleasure. Thank you.
Thanks for listening to this week's episode of the show. Quick reminder that New Foundations is for informational and entertainment purposes only, and nothing should be construed as investment, financial, or legal advice. Business owners, business operators, and those who are Bitcoin curious, let's connect. Visit acropolistreasury.com to learn more or to get in touch with our team.